Welcome back. Something much different today than anything we've gotten into yet, although we have mentioned stock control several times in the past. And yes, I know that you've been bombarded with a lot of information in these lessons so far, and obviously more to come, but the good news is that we are definitely past the halfway mark at this point. Now this lesson and the next three after are all going to be stock control related, so 4 back to back that are all going to be stock control related. Basically starting with this one and then building on our foundation from there. Now we won't get too deep into BPOS related stock control topics and components in this first lesson, although we will mention them a couple times. We will in the next lesson, which will be titled Stock Control 101, and we'll get into all of the specific BPOS things related to stock control. We'll start getting into them. Now this should be a relatively shorter lesson today compared to the past couple, so we'll just get into it. There's no agenda really to mention. Like I said, for now we're just going to be sticking to some stock control general concepts and then building on that knowledge as we go into deeper stock control topics that are BPOS specific in the next few lessons. Okay, so maybe you have no prior knowledge of stock control and stock control concepts. Maybe you're brand new to the industry, or maybe you are a seasoned veteran of the industry, but you have not encountered stock control just yet. Either way, whether you do or don't know anything about stock control, we are just aiming to be as comprehensive as possible before we dive right into our stock control components that we've got in BPOS over the next few lessons. So that being the case, we should start with answering the question, what is stock control? One way to define it, and this is partially a dictionary definition, is that at its core, stock control is the cumulative ongoing process of keeping track of product and product movements. Now that's the end of the definition there. Now there are several other processes and procedures that can happen within an overall stock control program, but at the most basic level, the idea is simply to track and monitor product stock levels. Now, when stock levels are being tracked and monitored through things like analyzing stock reports, which we've gone over a few of those, and conducting regular stock takes, which we haven't gone over yet, but we will. So when those things are being tracked and utilized for analysis and so forth, businesses can then make some important decisions from there. From that, they could determine maybe what should or shouldn't be sold to begin with. They could determine what products could be promoted and which ones shouldn't or don't need to be, and potentially what products should be purchased in higher quantities versus what should be purchased in lower quantities, so on and so forth. There is a quote-unquote life cycle to all of this, and it starts when product is purchased and brought into the venue in the real world. Well, really I should say that when it's purchased and brought into the store in the real world, but we'll touch more on that in a minute. The life cycle can actually start before bringing product in if the business is proactively placing purchase orders, but we'll get to purchase orders in just a few minutes. So whether the business is placing purchase orders or not, whichever tracking system is being used, in our case, of course, the tracking system is BPOS, that system needs to know about purchases so that product quantities are updated in the database of that system. Even if it's just a piece of paper, a pen and paper ledger that's being used to track, the system needs to know when product is being brought in so that quantities can be updated. And then when someone looks in that system, they can see what should theoretically be physically in-house at any given moment. After being purchased, the most common next step in the life cycle of a product is to just, sit on a shelf or in a warehouse or in a cool room or somewhere until it is sold to customers. But aside from being sold, there are a handful of other things that can happen to a product after it's been purchased and brought into the store, some internal stock movements. Now we will get much more into the details of possible internal stock movements in an upcoming lesson that is going to be devoted to internal stock movements, but for now we can think of a couple basic ones at least. First being that product can be transferred around a venue. Now this is going to get a bit into BPOS related stock control for a second, but it's important to note, and I'm sure I'll mention it again, I've mentioned it several times in the past, but stores hold stock in BPOS, not venues. The implication from a stock control perspective is that within a multi-store venue or a multi-venue organization, stock can be transferred from one store to another. But anyway, we'll chat more about transfers and our other internal stock movements in a couple lessons time. But the other common occurrence is that product is spoiled or wasted before it gets a chance to be sold. Now, all of these stock movements, whether it's a sale or something else, should be tracked as part of the stock control program. Basically, whenever something happens to a product in the real world, there should be a matching record in the system so that product's quantities can be updated in the database. Now, rounding out this ongoing product lifecycle are periodic stock takes that the business can conduct. We'll get into the details of stock takes later, and then in an upcoming lesson we'll run through the workflows that are involved for BPOS specifically. But essentially we can think of a basic scenario like this. So let's say that we operate a single store venue that only sells one product, cans of Coca-Cola and nothing else. So just one store, one single product, keeping things simple here. In this scenario, we could probably even track our stock level just on paper. It would be, rudimental, but it would work. But anyway, when we first open the store, we purchase one case of 24 cans of Coca-Cola to get us started. That first day, we sell 10 cans, so if we look in our stock control system or at our sheet of paper, if we're using something that simple, at the end of the day, we'll be able to see that there are 14 cans left, or there should be 14 cans left. That's only what we should have. That's theoretical. Maybe a can rolled under the fridge or someone stole one, then the actual number of cans won't match to that theoretical number. But we don't know that yet. We just stick to our theoretical number that's in the system or on our sheet of paper, and we trust that nothing else happened to our cans of Coke. Now the next day we purchase another case and we sell some more. Later in the week we purchase more again because we've sold so much Coca-Cola at this point, we're just trying to keep up with demand. Business is booming. There were a few cans that were damaged, so we entered them into the system as waste, or maybe we just scratched them off on our sheet of paper as a loss. But that's okay. We're not too upset about that. Business is going great. Then at the end of the week, we can look in the system or on our paper ledger, and we can see all of our purchases of Coca-Cola that we've been tracking. We can see how many were wasted, we can see how many were sold, and then theoretically how many we should have left. What we can do then is conduct a stock take. Basically, pause what we're doing for the moment within the business before another busy day of slinging Coca-Cola cans to thirsty customers, and we're going to get a snapshot of how much product we've actually got on our shelves at the moment. So let's say the system or our paper ledger says that we should have 100 cans, then we can go and physically count how many cans we do actually have. Maybe we only count 95. So we have a variance of -5 cans. Somewhere during the week, either a mistake was made when we received more cans of Coca-Cola and we didn't really receive what we were supposed to, or some cans were damaged but we were busy and didn't get a chance to mark them down, or we made a mistake during a sale, or maybe someone stole some. But whatever happened, 5 cans are in some way unaccounted for. But that's okay. We are going to take note of it and we'll keep a closer eye on things next week. For now though, thanks to our stock take that we've conducted, we know that our updated real quantity of Coca-Cola cans is 95, and the system or paper ledger will now reflect what we do physically have on hand. The following week, we repeat this process. We sell more Coca-Cola, we purchase more Coca-Cola, we have a couple cans get damaged, we get thirsty and drink some ourselves, but we still account for those in the system, of course. And at the end of the week, we conduct another stock take to check for any variances between what we should theoretically have on hand and what we actually have. Wash, rinse, repeat, so on and so forth. that is stock control in a nutshell. That's sort of this life cycle in a nutshell. And hopefully that little anecdote there also highlights why stock control is important as well. Basically provides an internal system for tracking stock movement and stock levels, which is of course vitally important for any business to run efficiently. But yeah, it's a basic rundown of a stock control product life cycle. Now, as a prerequisite to being able to purchase products and bring them into the business, a business does need to have suppliers to purchase them from. Now, you may know some of this already, and I don't mean to insult anyone's intelligence. Again, just aiming to be as comprehensive as possible for anyone who is not familiar. But in the real world, businesses will establish relationships with reputable suppliers that they can provision items from. And those suppliers will then have a delivery schedule that they follow, and they'll communicate that to the venue. So they might say, we deliver to your area every Tuesday and Friday between 6 a.m. and 10 a.m. Make sure you get your order placed with us by noon on the previous business day. That's our schedule, and that's our cutoff time if you want us to deliver to you. Or another option could be that someone from the venue runs to the nearest supermarket or restaurant supply warehouse and purchases products as they need them. But either way, in BPOS, the supplier would need to be set up in the system so that we can easily place orders with them, receive stock from them, do a number of other things that we'll discuss over other lessons. In the latter scenario there, where someone's running out to somewhere to pick up product, that still does need to be tracked in the system, or should be tracked in the system, and would need a supplier set up for that. Obviously not to receive stock from them, but to receive stock into the system at least. But we will get into setting up suppliers in BPOS in the next lesson. But yeah, without suppliers, we cannot begin the stock control life cycle, so they are very important and worth mentioning for now at least, especially because when we do preemptively order products from suppliers, when we create what's called a purchase order, something that I've mentioned a couple times there and some of you are probably familiar with, but for those who are not familiar, placing a purchase order is basically putting a list together of the products and quantities that the business would like to purchase and then communicating that to the supplier. Then on their next scheduled delivery, the supplier should bring the products and quantities that were ordered, along with an invoice to be paid for those items. First, let's elaborate a bit more about what purchase orders are. So broadly speaking, a purchase order, which by the way is often shortened to the acronym PO, and this is another dictionary definition here, but a purchase order is, quote, a commercial document and first official offer issued by a buyer to a seller indicating types, quantities, and agreed prices for products or services, end quote. But to continue with that definition, actually, this is a sub-definition of it, is, quote, it is used to control, purchase order is used to control the purchasing of products and services from external suppliers. In the hospitality and retail industries, purchase orders are placed as a means of easily ordering the same or similar products from the business's suppliers on a recurring basis, and they really do serve as a key pillar of stock control, especially in systems like BPOS, where we are able to house a database full of products and the suppliers that they're purchased from, as well as which system that facilitates the creation and sending of purchase orders and receiving invoices. Which brings up the point that purchase orders are a very useful tool for tracking and record keeping, aside from the other benefits that we have of being simply updating product quantities in the system, but for both the purchaser, the business in our instance, the venue, and for the supplier, by using purchase order numbers, supplier codes, product descriptions, etc., other information to keep accurate records of what's been ordered by the business and then what's been delivered and invoiced by the supplier. And hopefully everything matches along the way from purchase order to delivery to invoice. Now, lucky for us, thanks to modern technology, purchase orders can be sent to suppliers in a number of ways. That can be done by email or other electronic means, such as supplier portals, intranets, websites, things like that. We also have a supplier communications component built into BPOS that is unfortunately out of the scope of this course, but we do have plenty of documentation in both written and video formats for you if you are interested in supplier communications. By all means, orders can still be placed the old-fashioned way, over the phone or even in person, but a purchase order should still be created in a stock control system so that when the delivery comes in, there's a record that it can be attached to, and the same workflow can be followed every time. We will be looking at that workflow for BPOS in the next lesson. For now, while we are still focusing on stock control general concepts, let's think about some best practices for purchasing and receiving. Again, you may very well be familiar with a lot of these things already, or even have your own best practices that you would recommend to follow. These will vary slightly amongst industries, but when dealing with food and beverage, there are a few which should be adhered to pretty much across the board. So without getting into the pre-purchasing activities, the nitty-gritty of supplier relationships and negotiating prices and contract buying and that sort of thing, or the post-receiving practices like the importance of food storage and handling, we can still talk about some suggested best practices of just the purchasing and receiving aspect or portion of this life cycle. First thing would be to set and stick to an ordering schedule. This will provide consistency, and it's beneficial for the venue as well as for the supplier. It will also help with determining other practices. And oftentimes the schedule is simply going to be determined by the supplier when they're able to deliver to the location, and that will be communicated. Also, number 2 here is to set par levels. So these are referred to as minimum and maximum quantities in our product records in BPOS, but having those set will minimize stock losses while also ensuring that enough stock is kept on hand. These should be based on sales and product usage and may need to be adjusted from time to time. But basically the idea is to buy only as much of a given product as is anticipated will be needed to get by from one delivery to the next. Exceptions to that may depend on pack sizes. So maybe we only need 100 takeaway containers to get through a week between deliveries, but maybe the supplier only sells cases of 1,000 takeaway containers. Our hands are kind of tied there. Also, perishables should be more closely monitored and bought as frequently as possible. And keep in mind that just because something is non-perishable is not a reason to buy it in quantities larger than needed unless there is some great deal that the supplier is offering and we have the space to hoard some product. But just keep in mind that every item in inventory has a monetary value that could be saved or spent on something else. Now, another best practice is to check stock levels prior to creating purchase orders to determine exactly what is needed. Back to the Coca-Cola example from earlier, it will not always be possible to get an exact physical count. So more often than not, the business is relying on theoretical quantities that are in the system when placing an order, but it's still important to check those numbers and double check quantities that are being ordered before sending the purchase order to the supplier. So after we've keyed in the quantity that we would like to order, that we're placing, that we're entering on the purchase order, double check those numbers, make sure something hasn't been keyed in incorrectly. Then during the delivery or receipt of the goods, ensure that the quantities on the supplier's invoice match to what's actually being received and match to what's been ordered, and also that the quality is acceptable. So no damaged goods, dented cans, produce should be fresh, it should be temperature controlled, frozen product shouldn't be received partially thawed, so on and so forth. And lastly, it is very important to keep records of all these things: purchase orders, invoices, any shortages, transfers within the venue, stock takes, etc., and to conduct full stock takes at regular intervals. Speaking of stock takes, I've mentioned these a few times now, but before we get into the workflow of stock takes and BPOS in the next lesson, let's have a bit of an overview of stock takes in general first. What are stock takes and why are they important, in case you're unfamiliar? So stock takes or stock taking, also sometimes called inventory counting or even just inventory, depends on the region of the world that you're in, but it is the process of counting and verifying physical inventory quantities of products that are on hand and comparing them to a theoretical quantity. It's basically an audit of sorts that lets the business know of any stock discrepancies so that they can then attempt to determine the cause of those discrepancies. We had an example of that earlier with the Coca-Cola single store anecdote. But even if we aren't comparing physical stock counts to a theoretical quantity for self-auditing purposes, businesses also typically use their inventory counts to calculate the monetary value of their current stock holdings, which they may need to do at the end of their financial year for business or tax purposes. That's one of the reasons for, end of financial year or end of season sales. Businesses are not only hoping to clear old stock to make room for incoming stock. Historically, there's also a common sense, possible laziness component to it. They were hoping to have their shelves as empty as possible when it came time to count so that there would be less product to count. So going back to my earlier question of why are stock takes important, to summarize, stock takes allow businesses to regularly monitor and analyze revenue and stock levels, reduce loss and waste, and improve stock control methods overall. So the next concern might be how often to conduct stock takes. And there is a lot that will go into making that decision, and there really is no right or wrong answer. It will depend on business needs, seasonal or other cyclical requirements, possibly even due to unforeseen circumstances. Now, at minimum, most businesses conduct stock takes once a year, but some may do it quarterly, monthly, weekly, even daily. Maybe just some products are counted daily. Now, in saying that, more frequent stock takes will oftentimes just be what are called partial stock takes, where only certain items are counted, so items that move more frequently, either they're high cost or high volume products that need some extra attention. Now, from personal experience, stock take intervals can fluctuate over time as well. For example, if maybe monthly stock takes are typically conducted, and through the course of conducting a monthly stock take, something seems fairly out of line in the venue, maybe only draft beer, for example, the business may then opt to do a mid-month or fortnightly count of just the draft beer stock in order to keep a closer eye on that until things start to balance or look a bit better. But yeah, stock take can really be summarized into just a few steps. We're going to count stock on hand, we're going to record and enter it, and then at a later date repeat those steps and compare the theoretical quantity on hand, which is based on the previous or starting quantity on hand, plus and minus any adjustments, so all of our purchases, transfers, losses, other adjustments, and we'll get to those in the internal stock movements lesson. And then, of course, subtract out sales, and that's going to give us our theoretical ending counts, which we can then compare to the actual counts. But again, we will get more into the specific BPOS workflows for conducting stock takes in an upcoming lesson. That is actually going to be a wrap for this one. I said it would be a short one, and it certainly was. But thanks as always for your time and attention. Until next time.